Stablecoins are booming, with over 200 billion in market as of the time of this recording, and a clear path to 1 trillion over the next 3 years. But the truth is, many issuers, especially those just getting started, are walking a razor's edge. One misstep, whether it's compliance, reserve management, or smart contracts, and it could all come crashing down. Want to make sure your stablecoin not only survives but thrives? This episode is for you. And here's the kicker. Stablecoins aren't just a financial tool. They're now a centerpiece of the incoming Trump's crypto agenda, with massive implications for the dollar's dominance on a global stage. Stick around to the end, because what we're about to reveal could completely change how you see the future of stablecoins and their role in reshaping America's US dollar financial legacy. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, make sure you subscribe to continue getting top-tier content for your crypto company or on-chain organization from industry experts who have been around the block. I'm Nick Ward, and I'm here with Jeremy Nau from the network firm. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry.
Stablecoin issuance isn't just about innovation. It's a balancing act across multiple dimensions. From securing airtight regulatory compliance and ensuring your reserves are robust and transparent, to building bulletproof smart contracts and operational systems that can withstand anything. Every piece matters. Add to that the need for clear governance, proactive risk management, and user protections that inspire confidence for your users. With all that, you might have a blueprint for success or failure. It all begins with the cornerstone of it all, regulatory compliance. Let's unpack what you need to know to lay a solid foundation. Nick, thank you for being on TNF Takes today. Let's dive in. Can you give us understandings or some best practices for stablecoin issuers as they think about and consider being compliant on the regulatory stage?
Yeah, hey, Jeremy. It's good to be here. And of course, everyone's favorite topic, regulations and compliance with it. But obviously, when you're dealing with money, it's important and it's going to be a key factor in success of your business. So up front, right, where are you? What jurisdiction are you in is going to be step one, because you likely have some local requirements. If you're in the US, for example, you'll have money transmitter license, which is going to be required for each state you're going to operate in. And each state, unfortunately, has a little different process. So working with us, for example, will help you identify maybe the states to start in, which likely is higher bars in terms of what you need to do so that you can then roll that across the others. From there, you also have New York, right, has the NYDFS, some specific circumstances, which somewhat kudos to them because I think they laid out a pretty nice plan in terms of what you should be doing. They require monthly attestations, for example, controls annually. These are things that I think are positive in terms of running a stablecoin because we do need to be extremely careful. We've all seen depegging events and don't want that. So they have specific requirements as well, just to give some of the nuance that even within the United States, you do have different requirements. And then outside of the US, right, there's some global ones like Singapore has some very clear regulations, MiCA. So the goal is to identify where you're going to be operating, right, and meet those. And then the other piece is you might be thinking, hey, I want to get started and I want to be launching my stablecoin everywhere I possibly can, right? Be careful, because that means you've got to deal with all those regulations at the same time, which is really not a recipe for success. So start slow, focus on one, and then continue to roll from there, because hopefully you're also scaling the market cap for your coin at the same time, and which will allow you to kind of build out your compliance team, because you will need a full team to meet all these license requirements.
Yeah, those are some great points, Nick. Another tip, as you think about the kind of KYC and onboarding, is that there's technologies out there too that can help you with this, like Jumio or SumSub. So, of course, you need the people to operate your compliance function, but you also need the technology too. So make sure that you look out for alternatives that can help you streamline that process.
Yeah, looking forward to the compliance AI agents, right, when those are good enough to rely on.
Yeah. Yeah. And what I've also seen actually too is that there's actually multi-parties involved in the stablecoin issuance sometimes where it's not, it's a stablecoin issuer, but they might leverage fiat rails that might get the licensing. Like a Braille or a bridge right? You might be the front end facing stablecoin issuer, but you're using their fiat reals and their licenses on the back end. So that could be another way of kind of piggybacking licensing off of, partners that you can work with too. So there's ways to streamline kind of your compliance, and there's different models to consider too. You can get the licenses yourself, or you can work with partners to potentially get there and outsource certain functions to them.
Yeah, that's a great point. I totally agree there.
Yeah, the next topic we got, topic number 2, reserve management. Of course, this is a huge part of stablecoin issuance. There's two main sides of the equation, right? You have the tokens actually issued and outstanding, and those need to be adequately backed by reserves held at bank or custodial accounts. So, of course, the recommendation here for fiat-backed stablecoins is to prioritize highly liquid and low-risk assets. So, of course, cash deposits. Short-term U.S. Treasury bonds, typically less than 3 months, would be the recommendation. But there's also some other instruments that are highly liquid too that might be able to work, like repo or repurchase agreements. And then you could also consider Treasury money market funds that have a par value of at $1. Effectively, those are a basket of underlying treasuries or cash balances that effectively mirror $1, so that you can potentially use those as well in your basket. You're going to want to avoid risky investments like high yield bonds, even long duration instruments. You're going to want to probably not put into your basket. Like think about a 10-year treasury or a bond. That duration risk is not going to match the redemption potential of your stablecoin, right? If you have a bond that comes to maturity in 10 years, but your issue or your token holders are redeeming today, you're going to have a liquidity mismatch. So you're going to want to make sure that you keep everything, under 3 months as much as possible. So those are the yeah.
Go ahead.
That's reserve composition, right? Nick, you had something to add there?
Yeah, I think the key point you made was, right, be careful with the long-term durations and I think we've seen stablecoin issuers sometimes try to do the balance of, well, I can expect that, 20%, 30% won't be redeemed in any short-term manner. So maybe I have a larger partner that's put on the stablecoin for liquidity's sake, but I don't think it's safe to ever make that assumption as a stablecoin issuer. Your mindset should always be, hey, I need to redeem because that's a core function of the token, and your investments, your reserve assets should reflect that.
And then also on the reserve management side, the other consideration is segregating the reserve funds from your company's operational funds. So you could do that in a couple different ways. Of course, you should at least start with separate accounts. Like, right, you might have a bank account, but you should at least have banking partner, at least have 2 separate accounts, right? One for company, one for reserves. And for that separate account, you should clearly distinguish that those are your reserve assets backing your stablecoin. You should put, stablecoin X reserve fund or something like that, just to clearly distinguish that they are separate. But you might also consider more legal separation between the reserve funds and your company. So you might consider a trust or, a foundation, right? Or even a separate legal entity to hold the reserve funds to really separate them from the company operations and company funds. That's a way, if there was a bankruptcy for your company or some other issues, right? That distinction would be helpful to make sure that all the token holders remain whole and have access to those, the reserve fund. The last consideration is, of course, on the reserve side, is to diversify your custodians. We've seen Silvergate, we saw Signature, we saw Prime Trust. These were all huge counterparties to stablecoin issuers. And we can see what happens. One day they look like they're the best option out there, and then the next day they could be gone. So you're going to want to make sure that you have a diverse range of custodians. You might even think about multi-jurisdictional custodians to make sure that you really cover your basis and cover your risks for not relying singularly on one single counterparty to hold your reserve asset. What do you think, Nick? Did I cover everything there?
Yeah, I think you did. I mean, those last 2 points are big. Diversify custodians, and then even the segregation, because I know, again, starting off your business, you need to get running, and that seems like a secondary thought or an after the fact. We'll do it later, but it's key in management. It helps your internal team see a very clear picture of what you have where, and then you can act accordingly. But I think with that, I was going to roll into the smart contract security, which is going to be another key factor, obviously. Step one is if you're using your own developed contracts, let's get them peer reviewed, get them audited to ensure you're issuing and managing the stablecoins under a sound contract. If you're going to be utilizing others, as we mentioned, that could be a better part of the stack in terms of compliance and just efficient operations. Make sure you're partnering with reputable blockchain security firms to identify vulnerabilities of them, and you're requesting audits in your due diligence process if they're not upfront with them. From there, it's not just a one-time thing. You're going to want to conduct regular code audits, penetration testing to prevent any exploits, and ensure you're doing this across the board, right? So if you're issuing on multiple chains and there's different contracts on each chain, you're doing that for all of them. And from there, then you'll also want to be watching out for the upgrade mechanisms. So build secure mechanisms for upgrading contracts, and ensure you're doing that without compromising user funds or the integrity of the contract.
Yeah, those are great points, Nick. And there's some tips and resources out there for stablecoin issuers that, like, for example, Open Zeppelin or some of these security firms, they have, battle-tested smart contracts for stablecoins even, or other functions that you can actually just take out of the box. And these are ones that have been tried and true that you can simply inherit, right? And then change and tweak based on your specific stablecoin characteristics. Also, right, if you're using EVM chains, if you're deploying on multiple chains, there is some operational efficiencies of doing that, because if it's the same code across these chains, you really only need to get it audited once, right, as long as the chains have the same underlying characteristics. So as you think about the chains you're deploying on, that could be a factor, because you get some scale that way too.
Yeah, absolutely. And I think then outside of like the code's specific pieces, right, you have just kind of general controls, which hopefully your CPA firms identifying these things, helping you through this process by calling these out. But you have, access to the contract, right? Just basic controls. Do you have a multi-sig? Who has pieces of that and has the ability to mint and burn? Do you have a disaster recovery plan if there is a technical failure? And then from there, do you have clear governance framework, right? Like who's doing what at the company, who has access, who's ensuring reserves are reconciled and monitoring them month to month. Those are all keys, and those are, standard TradeFi controls in place over finances that should be applied in this scenario just as much.
Yeah, those are great points. The point of controls is pretty key. So when you think about controls in your stablecoin infrastructure, of course, you're going to have two main sides of the controls. Of course, you're going to have general controls like Nick alluded to, but on the token side, right, you're going to want to make sure that you have clear controls related to the governance of the smart contract itself. So, making sure that you have multi-sig on any upgrades, or making sure that you have mint burn controls, multi-approval schemes. It can be using a system on top of your smart contract or directly embedded into the smart contract, and you can interact it with Gnosis Safe or something like that. So for mint burns and upgrades, those are key, right? You're going to want to make sure that you build those in. Then on the reserve side, of course, that's on the fiat side. You're going to want to make sure that any movement of funds from your reserve accounts, right, have controls baked onto it. Make sure that there's dual approvals. I will caveat though that you might be able to put parameters or limits, right? So like, let's say you're minting, a small amount of tokens, call it 1, 10, 20, 1,000 tokens, right? You might set different thresholds or different approval thresholds if it's a lower amount versus if you're minting, 1 million or 10 million tokens. So you can build different levels based on the risk, right? And you can do that also on the fiat side, right? If it's a $10 transfer from the reserve account, maybe you don't need a second approval. But if it hits a threshold like 1 million or 10 million, you would want to do something like that. So think about those as you scale too.
Yep, all good points. And I guess circling back, right, so we topped off with regulatory side, you'll also want to double check privacy, data security, right? If you're getting specific user data, you might have that data privacy regulations to comply with, the GDPR in Europe, for example. And you may also have to have, clear dispute resolution practices, right? If someone has a chargeback or claims a misredemption, something like that, you need to have a process in place, not only to handle customer satisfaction, but regulators require these things as well, and will require you to prove them in some cases.
Yeah. And I think what goes with that is making sure that you have clear redemption policies, right? So your customers are going to need to know, like, hey, what should I expect? Am I going to get if I burn a token, am I going to get my funds within 1 day, 3 days, 5 days, a week? Is it up to the issuer? So making sure that you have clear and conspicuous, what's often seen in the legal language, clear and conspicuous redemption policies. So make sure you put that in your user terms And when your users are creating an account, they should accept those terms. That way, you're covered from a legal perspective too. I think our last point, Nick, is around transparency and auditability. Of course, we talk about the internal operations so far, but what's key about stablecoin issuance and stablecoin usage is that your users can trust your stablecoin. They want to make sure that your stablecoin is actually backed with the reserve assets that you purport to hold. So that's where attestations and reserve audits come into play. So the industry standard at this stage, like the baseline or the lowest bar, is getting attestations on a monthly basis. This is what Circle, Paxos, GMO, for example, these are the ones, this is the industry standard that has been adopted, and it's mostly been opted-in by most of the industry today. However, Tether notably does these on a quarterly basis, but they are international, not in the US, and they also don't have a requirement to get these monthly attestations, which is why I think they've opted into doing these on a quarterly basis. However, there are real-time monitoring systems now that can really up the bar, and you can use transparency as a competitive advantage compared to other issuers out there. We've built a real-time attestation system where you can report on reserves and tokens as frequently as every 30 seconds. So this is key for building trust in your user base. This is on the attestation side. There's also the financial audit side that might be required as part of your licensing regime if you're getting an MTL or going for MiCA compliance, for example. But usually the financial statement audits aren't for building trust with your users because typically those aren't released publicly, right? Your full financials, but they are typically submitted to your regulators, right? So your attestations oftentimes are giving confidence to your users, and those financial statement audits are giving confidence to your regulators. So when you put those together, you're at a pretty good spot of transparency to the appropriate parties that you need to be concerned about. Nick, any other thoughts on audits, attestations, and transparency?
I think you almost hit that one, perfectly. Again, check jurisdictions, because we have seen, New York, for example, isn't just requiring the audit, it's also required the monthly attestations, and they actually have specific terms that they want to see not only a snapshot on the last day of the month, but then have the attestation provider, the CPA firm doing the audit, pick a random day. So their reports are 2 days each month, and they require that from a regulation standpoint. My guess is all of these regulatory regimes are going to keep changing. So keeping an eye on them and kind of being ready for, okay, now I have to do the monthly attest, right? Do I have a partner ready to go? I'm going to have to find that. Am I prepared internally? And those are all key steps to be ready for that stage.
Yeah, and what can be hard for issuers is that they might have a requirement in New York, and they have another requirement in Europe and another requirement in Singapore. And that's why we alluded to probably starting with one or a couple jurisdictions at the beginning, because they might have different rules, and you're going to have to layer on all these different pieces of the compliance program to ensure that you comply with all these different jurisdictions that might not be a one-to-one match, and they have their own set of rules. So something to certainly consider.
Yes. All right. I think it's time for the outlook on what we think the incoming Trump administration is going to look like for stablecoins specifically.
Yeah, what's interesting about this, Nick, is that people have heard about like the strategic Bitcoin reserve, or revamping the SEC and making crypto the capital of the world, or the U.S. the crypto capital of the world, and hiring David Sachs as the new crypto czar. But there hasn't been much talk specifically about stablecoins. So I think what's underestimated is people don't really understand, well, what do these things have to do with stablecoins? Well, maybe this whole thing is actually about stablecoins. Maybe everything that has been talked about is actually to incorporate stablecoins more into America's financial future. And really, the question is why? I don't know, Nick, have you seen like Luke Groman's thesis on, I think it was Peter McCormack's podcast with Preston Pish, and why the U.S. might really want to have a larger crypto market?
Yeah, I have actually, fellow local guy here from Ohio, Luke Groman. So been a good fan of his stuff for a while. And yeah, I think that, to your point, right, what do stablecoins have to do with the US dollar, and why shouldn't the US be fighting them, right? And it really comes down to what you laid out in the reserve management part earlier, is stablecoin issuers, they need to reserve their assets, right? And They need to hold dollars to do that, but they need some type of short-term investment to earn some yield to handle their operations, because it's not free to issue and manage a stablecoin. All of the steps cost money, right? We've talked a lot about compliance and the cost to do that. So how do they do that? Short-term treasuries, and they earn a yield on those reserve assets they're holding in between redemptions, right? So yeah, that's part of what Luke lays out, is that stablecoin issuers are really likely to be the largest buyers of U.S. treasuries, which ultimately is good for the dollar. If we've looked past the last 10, 20, 30 years, right, there's been times where when those rates are very low on treasuries, the public isn't really buying. It's the Federal Reserve, maybe some banks buying, but that's it. So to keep that market going, they need buyers to avoid, essentially these large prints to just be buying it. And I think stablecoins are perfect entrance to do that.
Yeah, I mean, just as a data point, today, USDT is the 18th largest US debt holder if it were a country. Like, that's insane, right? That's more than most countries, 90 or 80% of countries in the world have holding US treasuries. So you can see that and we're just getting started, right? And that's only one stablecoin issuer. So you can see if this really start to pick up, if the stablecoin market cap 5 stablecoins might be a top 3, maybe even higher, U.S. Treasury holder long term. So really, stablecoins are a way of preserving the U.S. dollar hegemony and dominance across the world, especially with competitors like BRICS trying to move away from the dollar. Stablecoins are a way of embedding dollars into systems throughout the world, because oftentimes access to dollars is wanted, but it's not granted by the local governments. So this actually happened too, like the U.S. when their debt levels were getting high, they had to be creative. This isn't the first time this has happened, right? In the 70s, when we effectively came off the gold standard after we didn't, adhere to our obligations to France when they wanted to redeem dollars for gold, we had to create a system to create a demand for dollars, and that was the creation of the petrodollar system, where effectively we made a deal with the Saudis to require the purchase of oil through dollars, and then the Saudis would buy treasuries, right, to finance our debt. And that was a way for us to go a lot longer in this fiat system. Well, something similar is happening right now with stablecoins. The larger the crypto market cap gets, the larger the stablecoin market cap gets, the more purchases of U.S. treasuries, and now the more the U.S. government can fund itself. So it's a crazy dynamic. I didn't even think about this until Luke brought it up, but it actually really makes sense. And now some of the actions by the Trump administration are kind of starting to make more sense to me. What do you think, Nick? Do you think that this is a conspiracy theory, or does this actually make sense to you?
No, I mean, it makes sense, right? I mean, to your point, Tether's the perfect thing to key in on here for the truth in it, is that when we're seeing that, right, largest holder, I think you said, it's just the administration's looking at the same thing, and they're seeing, all right, we know that we need them to be bought, right? Laid it out in the 70s, this example. So there needs to be a buyer of treasuries. And if you have one, why fight it, right? There's a positive there. And then at the same token, right, you have, to your point on stablecoins getting to people that haven't typically had access to the US dollar. That is also a positive for the dollar, right? Monies are networks. You need people using them for them to really have the value, or that all of the characteristics of a money. And so if we are able to take the US dollar via stablecoins into jurisdictions that haven't typically had access without all of the capital requirements to spin up banks and get local regulations in place to operate those banks, that's a positive for the US dollar. It's more people on it, and it extends that life of the US dollar system. So I think the Trump administration understands that and is going to do what they can to ensure it continues on that front.
Yeah. So it's funny, after, years of challenging political and regulatory environments for, crypto at large, but especially stablecoin issuers, the future now may look bright, right? There may be some political tailwinds for this industry. However, that won't come without fierce competitions as an issuer from other issuers, right? There's a lot of incumbents that have entrenched themselves and have pretty large market caps, and there's new entrants every day. Make sure that you use our tips to build a stablecoin that can thrive on the global stage. Until next time, this has been TNF Takes. Nick and we thank you for joining us. We'll see you next time.
Thanks, Jeremy. Thanks, everyone.
Thanks, guys.